Interest on this loan is not amortized. It's not predetermined. Instead, we're going to recompute interest nightly, every single day at midnight, specifically midnight, Eastern Standard Time. Interest is computed. It's simple interest, not compounded, and it's not amortized. Whatever's owed on the HELOC times the rate divided by 365 is that day's interest expense. Now, our customers aren't charged that interest daily. It's just recomputing nightly in the system. And at the end of the month, each day's interest is totaled up, and that becomes the interest that's due for the month. But even then, that interest payment isn't due until the 21st of the new month. So in real terms, all of our all-in-one loan customers today, their May interest payment, which equals 31 days of cumulative interest for the month of May, that's not due until June 21st. And where it'll be automatically drafted out of their HELOC, out of their all-in-one loan line of credit automatically without them having to lift a finger. It's extremely hard to go late on this loan because your payments are automatic. It's just the interest only. You get to control your principal. You want it to be high, you want it to be low, you want to speed up the process. You want to use cash savings that's in an account earning 0.5% to help offset your mortgage balance and save you 4.5%. I mean, it allows you to use your money more efficiently without losing access to it. So it's a very safe way to reduce, exposure to unnecessary costs that typically comes with a mortgage. Again, money kept liquid 24/7 through all the banking features. I'm going to run through a quick example, and believe it or not, we're almost done here with the information, and we're going to open it up to questions. But let me run through a quick example. I'm going to use the same numbers and compare our loan, the all-in-one loan, to a traditional mortgage, a 30-year fixed that somebody's had for 8 months, and they're at 3%. We're going to finance $500,000. Now, if you think about it with a traditional loan scenario, it doesn't matter what you make in income. After you have your loan in place, your income, your biggest source of money and volume of money throughout your working life, that doesn't matter. It's not being facilitated. It's not being used at all by the mortgage. It's in a separate account, earning very little, right? If anything at all. In our loan, income matters. What's driving through the checking account? What's that behavior look like? Is there any money idly sitting today waiting to be spent this coming weekend? Oh yeah, the average American household has a ton of money sitting around waiting to be spent on things that they have to spend it on over the next few weeks and months and years. So let's put the money to work. In this scenario, I have $150,000 on an annualized basis as an example, and about 75% of that routinely being spent out annually as well. This is a typical all-in-one loan scenario. I'm going to walk you through the first 90 days very rapidly here. Just conceptually, you start with a beginning loan balance when we close the loan. The banking welcome kit is received by our customers about 2 to 3 weeks after we close the loan. That includes ATM debit Visa cards, your temporary passwords to go online and log in to your banking portal. It's a consolidated banking portal where it shows you the checking account and the line of credit combined. And so you can see the money movement, money deposited, money transferred over, balance reduced, all in the same day. Money left available for expense spending, right? So your expense spending goes out of the account. You can log in to the app or through the online, your desktop version anytime you want to see this stuff. Bill payment, writing checks, whatever and however bills are paid in your life. You will our customers typically will end the month at a lower balance, finishing balance than they began with earlier in the month. And that's just leftover money is home equity money. So this loan drives down the balance naturally faster, building equity in the property at an accelerated pace. The reason why this occurs, the money that's left over includes not just the amount of money that you might not have needed to spend this month, right? But also the money that was normally budgeted for a traditional mortgage payment. If you, as an example, have a $2,000 a month P&I 30-year fixed mortgage payment, which is part of your income, you had to earn those dollars. And before you make that mortgage payment, those dollars hit your checking account. And instead of doing it that way, what if we refinanced you and said, let's consolidate the two accounts together, give you a more efficient financial tool. So you deposited your paycheck directly into your all-in-one loan. Well, you effectively are now using what you used to spend on a mortgage payment to drive down your principal balance by $2,000 and the rest of your paycheck the day you make that deposit. And from there, If you were used to spending the money on a mortgage, you should be as comfortable keeping the money with you in the HELOC. If you do that every single month, that compounds. That compounds the savings, compounds the equity acceleration or gain in the property. Month number 2, another deposit on screen here as an example. Periodical spending. There's the interest payment on the 21st of during month number 2 to pay for cumulative daily interest from month number 1. Just automatically drafted out of the line of credit. Statements are cut on the 1st. So our customers see exactly how much interest is going to be drafted from the line of credit on the 21st of that new month. If you think about it, this is interest paid for in arrears, principal paid first. This is the only, to my knowledge, still the only principal paid first mortgage in America. Not even a traditional HELOC does that. It doesn't matter how much or on what day or to what routine money is deposited into the accompanying checking account. All of that money is transferred to the HELOC and pays down principal, regardless of when that's done, all the time. That keeps even the money that is needed to pay the interest payments in the line of credit for an additional 20 days before it's drafted out. Again, we are ending the balance at a lower place than where it started, building equity faster in the property. This continues to compound. Deposit, expenses, interest payment for month number 2, done on the 21st during month number 3. Ended with a lower balance and continuing to compound equity gain in the property. It's dramatic and very gratifying. Here's the results of this example. Would you rather be in debt for 360 months, or in this example, 352 remaining months on that 30-year fixed at 3%? Or would you rather have your mortgage paid off in 127 months for 10.6 years? Our average trajectory for all-in-one loan customers is in the neighborhood of about 8 to 10 years for payoff. I know people that have paid off their house in 4 years. They were astonished by it, just because it accelerates the principal reduction. And then turned around and use those dollars. Think of all the ways you can use this loan. You can pay down faster. You're liquid. Use it to go fund college education for a child without having to go get a loan. Buy a VRBO property. Go buy multiple VRBO properties. Go take advantage of the real estate market. Pay for medical emergencies that are unplanned or planned. Just a tremendous amount of things. Retire, live more securely. The average American household out there that is approaching retirement ages doesn't want to necessarily downsize. They would live a lot more independently and securely, probably be much more active in real estate and improving their own home if they simply have less debt, less housing debt, and had access to their equity money. They can manage it better. And that's the whole point of the product. Last slide, and then we're going to open it up for questions. I would like to point out not only Danielle's wonderful team that is, available to help answer questions and run you through you or somebody our interactive comparison simulator, which can be found on our public website, and that is allinOneLoan.com. Just simply www.allinOneLoan.com. We have an interactive calculator that just compares the all-in-one loan to a traditional mortgage. It also has other information on it, customer testimonials, a brochure, FAQs, a tremendous amount of resources, but most certainly depend on Danielle and her team to run scenarios for you and answer any questions. And I can also be available to help as well. With that, this was meant to be very high level and not really take up your entire day.